This conference will now be recorded.
Okay, so welcome back to a fresh new session of credit risk modeling, and we were discussing the different stages of development of a scorecard, right? So very quickly we'll walk through the steps that we had talked about, right? So the first step that we started of our discussion with was the scope and the gap analysis, right? So the objective of this step was to ensure that we would require the development of a scorecard. Now, once that is done, once the business justification is provided, and we start working and we start developing the scorecard, right? So the next thing that we try to do over here is we try doing the performing the data extraction exercise. So we extract the data on the different variables, right? On the dependent and the independent variables, and we have discussed the different kinds of challenges that we may face while we are extracting the variables, right? And once the data extraction is done, once the data warehouse challenges are sorted, once all the reconciliation checks and controls have been imposed, the next thing that comes up to us is the data quality check. And the objective of the data quality check is to ensure that the data that we have with us is a gold standard data, right? So it does not have any missing observations in any of the variables. All the observations that we have, all the variables that we have are properly classified as ID variables, date variables, continuous and categorical variables. For the continuous variables, there are no abnormal trends, and for the unusual variables, and for the categorical variables, there are no unusual concentrations, right? We have looked into the different ways through which we can analyze this part. Now, after the data quality check exercise have been performed, the next thing that we do is we so now I have all the variables on the I have all the relevant variables for the relevant time period, and these variables do not have any missing observations. They are properly classified. The continuous variables do not show any abnormal trend, and the unusual and the categorical variables also show no unusual concentrations. So this is the part up to where the analysis has been discussed until the last class, right? Now, from there, the next part where I move into is the variable selection. Now, I have all the set of variables, right? Variables which are relevant and which do not have any structural issues or any quality issues involved with them, right? Now, the next thing that comes out over here is that I now need to move into the next set of next stage of model development, which is variable selection. Now, from this list of all the variables, I need to zero down on a finer subset. So, what is that finer subset of the variable? Now, that finer subset of the variable is that subset which will consist of the list of most predictive variables, right? So the entire objective of variable selection is to identify the list of most predictive variables, to identify the list of most predictive variables. Now, when I talk about to identify the list of the most predictive variable, the question that comes out over here is that how do I decide on the predictive capacity of the variable? So when I say it's on the most predictive variable, the question that comes out to me is that how do I know that or how do I identify that which is the most predictive variable, right? So that's the next important question. Now, when I talk about to identify the most predictive variable, the question that comes over here is how do you define a predictive variable? So, a predictive variable is one which can clearly distinguish between the good and the bad. Clearly distinguish the y equals to 0 and the y equals to 1 between the y equals to 1 and the y equal to 0. So this is precisely what the concept of predictive variable is. So the predictive variable is one which should be able to distinguish clearly between the y equals to 1 and the y equal to 0 variable, right? Let us use an example to describe this. Let's say that the y equals to 0 is, say y equals to 1 if defaulter or if bad, then y is equal to 0, 0 otherwise. Right. So when I talk about this particular part, so what is this y equals to 1 if bad equal to 0 otherwise? So these are the two outcomes that a particular borrower can have, right? And there is always a proper analysis to identify the bad definition. So basically my objective over here is to frame an idea about the fact that whether y equals to 1 if bad equal to 0 otherwise. It's something like that. Now let's say this is the bad definition for a commercial borrow, for a commercial obligation, right? And I have the bank who is lending out commercial loans. Now, one of the matrices of identifying a commercial product is EBITDA. EBITDA stands for earnings before interest, tax, depreciation, and amortization. So EBITDA in short is nothing but it is a measure of profitability for the firm. Right? So it gives us a clear idea that whether how profitable is a firm. So this gives us an idea about the profitability of the of a firm. So this is precisely what the key objective is. So EBITDA stands for, or EBITDA is used to estimate the profitability of a firm. Now let's think about it like this. There are two firms which are applying for a credit, right? Let's say they are applying for a cash flow loan. Now, the cash flow loan is a loan where the loan is backed up not by any other assets but by the cash flow of the bank. I mean, cash flow of the obligor. So let's say they are asking. There are two firms which come up asking for the cash flow loan. Now, if I'm giving the cash flow loan in a cash flow loan, I am backing up the loan using the cash flow loan, right? So over here, in a cash flow loan, as I said, it is backed up by the cash flow or the steady cash flow of the bank. So this is backed up.
So Tanmay, what is the meaning of a cash flow here?
Yeah, I'm coming to that.
Okay.
Right? The cash flow of a firm. Right? Now, basically, let's say there are certain industries who do not operate on credit. Right? So there are certain firms which operate on credit, and there are certain firms which operate heavily on cash. Right? Let's say a company like Infosys or a company like Google. So these are companies which do not operate on credit, right? So what they do is they operate on the cash flows. They operate heavily on cash. So their businesses are backed up by heavy cash flows. In fact, to some extent, the healthcare centers, right, the diagnostic centers, they are also heavily cash flow driven companies or cash flow driven organizations. So basically, let's say a healthcare center or diagnostic center goes up to the bank to take up certain loan for buying their working capital. The bank would not be looking much into their physical balance sheet because these are mostly service driven firms, and hence they would not be having a very asset rich balance sheet, right? So they will not be having a lot of physical assets, unlike a manufacturing company. Now there are the second type of companies that we or firms that we have is firms which operate largely on credit, right? So say suppose I sell my good today, I will be getting it back 90 days, getting the money 90 days from the date when I supplied the product. So over here, what happens is the cash flows become so, in such a case, using cash flows to determine the health of the firm does not make much of a sense. So, what happens is, in such a case, especially say for manufacturing firms, etc., banks look into their assets, right? So, for such companies, banks would give asset backed loans. So, companies which thrive mostly on cash and cash based transactions are considered for cash flow loans by the bank, and firms which have a lot of asset rich balance sheets, huge physical assets in their balance sheets are concerned to be are considered as cash flow are considered for cash flow loans by the right. So this is precisely the basic difference, right? So these two are two different kind of loans, two different kind of lendings that are done by the banks, right? Now there are also other different kinds of lendings, but I'm using these two for demonstrating the concept of variable selection. Now, if you are giving your, if you are considering two obligors for a cash flow loan, you'll obviously look into the cash flow that happens into the organization. And one such measure to look into is the EBITDA. This is a measure of profitability and a very important metric for deciding acquisitions, for commercial acquisitions, for cash flow loan portfolios, right? So if you have a healthcare portfolio, right, you'll see that most of the loans are cash flow loans, some are asset-backed loans, and for cash flow loans, EBITDA becomes a very important factor, right? Also, movements in the EBITDA variable becomes very important. So let's see. So what does EBITDA stand for? I'll just repeat it once again. E stands for earnings. So E stands for earnings. earnings. B stands for before. Before interest, interest, tax. D is depreciation, and A stands for amortization. So this is kind of a measure of gross profitability of the firm, right? So before any kind of interest income or any kind of tax or depreciation, before adjusting anything, whatever the earnings have been. So this is a sole measure of the earnings that that this firm has been able to do. So higher the earnings, higher would be the profitability, and hence it's considered to be a measure of profitability. Now, how would you expect? Let's suppose I have a model, right? I have a scorecard, and the only variable that I have over there is EBITDA, right? Now, when should I include EBITDA for the further stages, or when should I process it for a model development exercise? When I will be very sure of the fact that EBITDA can clearly distinguish between the average behavior of the good and the bad borrowers. So EBITDA will enter into my model when I know that it can distinguish the average behavior of the good and the bad. Distinguish the average behavior between the good and bad. So if you think about this, let's say y equals to 1. So how would the average value of y equals to 1 group be different from y equal to 0 group? So over here you will see that. So if I say it's y equal to 1 group, y equals to 1 group implies a group where the borrower is a bad borrower, right? So therefore, if I take a bunch of the bad borrowers, average earnings before interest, tax, depreciation, amortization should be lower compared to the average of the y equal to 0 group, right? So what we expect over here is that average EBITDA, for y equals to 1 group should be less than the average EBITDA, the average EBITDA for the y equals to 0 group, right? So average EBITDA for y equals to 1 group is lower than the average EBITDA for the y equal to 0 group. So this is precisely what, or this is precisely how I would expect the variable EBITDA to distinguish between the good and the bad borrower. Because if I'm a bad borrower, the average earnings of my average earnings would be relatively lower compared to the average earnings of a good borrower. Right now, if this relationship holds, then I know that yes, EBITDA can clearly distinguish between y equals to 1 and y equal to 0 group. Now, the point is that these two may be less, so this may be less than this, but the difference between the two must be statistically significant. Must be statistically significant. And this is where, the testing exercises can actually come in. So, statistically significant. So I need to ensure that the difference between the EBITDA of y equals to 1 group and the EBITDA of y equal to 0 group is a statistically significant difference. So is this part clear? Rather, is this logic clear? Everyone, look into the logic. We'll delve deeper into this. Just check if you are comfortable with this concept, this logic or not. Then we'll move forward. Good. Okay. So, Anshul, Pradeep, Piyush, are you guys clear on this? Great. So, obviously, one part that comes out over here is, so the next question that we ask is, how do you identify whether this distribution or the average EBITDA value y equals to 1, whether it is less than the average EBITDA y equal to 0 group, and whether this difference is statistically significant or not. So how do we identify this? Now this can be done using multiple ways. Now since this is a continuous variable, we can deploy mean difference tests. Okay. So we'll deploy mean difference tests. And within the mean difference tests, there are multiple kind of testing procedures. There are parametric testing procedures, there are non-parametric testing procedures, and so on. So over here, we can perform a simple mean difference test. Mean difference test, right? So over here, one way of performing variable selections to perform mean difference tests. So basically, if the variables that is entering your model are continuous variables, so for the set of continuous variables, you can look into the average behavior of the continuous variables across the groups, and you can perform, and you can look into that, you can conclude on that on a very sound basis by using the mean difference tests. So what are the different kind of mean difference tests that we have? Now broadly, there are two different ways, or there are two different types of mean difference tests. So one of the mean difference tests are the parametric mean difference tests. Mean difference tests. So one of the mean difference tests that we have over here is the parametric mean difference tests. So what are parametric tests? So in statistics, parametric tests are those tests which start with the assumption of a we start with the assumption of a variable. So this is what we have is a parametric test. So in a parametric statistical test, you start with assumption on the distribution of the variable. So mostly it starts over here assuming that the variable x is normally distributed. Now let's say that if the variable is not normally distributed, how do you know? So we start by confirming or by validating each of the assumptions that a testing procedure requires. So we need to reconcile each of the assumptions, and from there we would be working with it. So one thing that we have is we have the mean difference test over here, and within the mean difference test there would be two broad type of tests. One is parametric, the other that we have is non-parametric. So non-parametric test procedures are procedures which are based on the observed nature of the distribution, right? And it does not start with any assumption or any a priori assumption on a distribution which needs to be validated. So any non-parametric test is based upon, well, based upon the overall shape or overall frame of the distribution. Right? So the non-parametric tests. So over here, before we move on, we need to understand in better details that what exactly is the difference between a parametric test and a non-parametric test. Just to refresh it once again, a parametric test, as I said, is a test which is used or which is created with an a priori assumption on the distribution of the variable, right? Mostly normal. And a non-parametric test is a test where you look into the observed distribution of the variable and you do not make any assumptions on the behavior of the variable, right? So for non-parametric test, most the tests are conducted basis the observed distribution of the variable, right? So how can that be actually working? Let's say we are trying to construct a distribution, right? So over here, what we'll have is, so over here, what we have is x comma y, and over here, what we have is fx comma fy. So So over here, what we have is f of y. So what I have over here is fx, and what we have is fy. Now I'll draw two distributions. One of the distribution is something like this. The other distribution is something like this. Right. So the mean of this distribution is somewhere around this side. Somewhere on this side, and I'll call this mu1, and this distribution has its mean somewhere around here, so I call mu2. So over here, my objective is to understand that this gap that I have between mu1 and mu2, this gap, so is this gap a significant gap or not? So that is where we need to test it, right? And our hypothesis over here becomes mu1 minus mu2, so mu1 minus mu2 is equal to 0, versus the alternate hypothesis where mu1 minus mu2 is not equal to 0. Mu2 is not equal to 0, right? So this is precisely what the idea of a mean difference test is. You try to assess whether, given that there are two distributions, right, and each distribution has a mean, right, and you see that there is certain distance between the two means. Now, what you want to explore over here is that does that satisfy, or is this difference a significant difference? Right? And now you can observe that we have looked into the observed distribution of the two variables, of the two groups, right? Therefore, this is this is nothing but this is a non-parametric test, because you are actually using the observed distribution of the variable. Clear? Just see whether this part, so whether you understood this part or not. So I'll just take a quick break. I'll just get myself a bottle of water and we'll start.
This conference will now be recorded.
Okay, so any questions up to this part? So is this idea of mean difference test clear? Perfect. Fine. So now the question that comes out is, so what are the different types of tests that we have in mean difference test? So one of the very famous non-parametric mean difference test, since we have talked about non-parametric test, is the Wilcoxon test. Is Wilcoxon test of mean difference. Wilcoxon's test of mean difference. Of difference in mean. Of difference in mean. Right. So this is one very important test. Now we'll be talking mostly about this test itself because the number of observations. So this requires that the number of observations in the two groups remain more or less similar. And because we do the averages across time and the same time period is considered for both the categories, the number of observations will be same. So this is something like a paired sample test. So this is a paired sample mean difference test. Right. So we'll come across each of these tests when we, so as we move forward, we will be coming across each of these tests, right? So we will be implementing each of these tests in model development. We'll be trying to understand how do they work, how are they implemented in SAS, right? So once that is clear, then we'll move on with the modeling side of things. So I'm just creating a list so that you can actually connect. So when I talk about a Wilcoxon test, or I talk about a T test, or I talk about an ANOVA, you should be able to connect. Okay, this is a so and so test which is being applied to solve so and so problem, right? So this is something that we will be trying to do, and that is why I'm just creating this framework using the different model development steps of a scorecard, so that you know that what test or what distribution is required at which stage, right? So this is a typical case of a paired sample mean difference test. Paired sample mean difference test, and this is a non-parametric testing procedure. Paired sample mean difference test, non-parametric. Now, can you tell me what exactly is a paired sample test? Because whenever I'm doing when I'm doing a mean difference test, right? I'm using two samples. So what is so special about a paired sample? Any idea as to what a paired sample test is? How is testing, right, between two groups of observations? Testing for mean difference between two groups of observations different from doing a paired sample t test of two groups or doing a paired sample mean difference test of two groups. Any idea? Okay, so Mrinma has a question over here. So while you keep try answering the question on paired sample and just two sample tests, I'll take a Mrinma's question over here. So the question that he asks is, the mean difference test that we studied using the graph is a non-parametric test, right? Yes, Rinma, it's so over here when we are plotting the graph, we are looking into the observed distribution that the variable may have for the two categories, right? And based on that, I'm trying to design some mean difference test measure. So this does not take into account any a priori distributions, rather looks into the observed distribution. And hence, this approach is a non-parametric test, or it's a non-parametric testing procedure. Clear? Okay. So, what is a paired sample? Now, generally, t-tests, apart from being parametric or non-parametric, so t-tests are classified into two parts, parametric and non-parametric, depending on whether we assume an a priori, we frame our test basis an a priori assumption of a given of a theoretical distribution for the variable, or we get classified as non-parametric, assume if we are not using any priori distribution, but rather we look into the observed distribution of the variable. So basis this consideration, we divide the tests into parametric and non-parametric. Now, another way to classify mean difference tests are to divide them as per the samples on which we try to, or we are looking to create the, you know, we are looking to create the distribution difference. I mean, we are looking to create the mean difference test. So, so basis the choice of the samples, there are two types of mean difference tests that can be proposed. One of the tests is an independent sample t-test. So one is the independent sample test, mean difference test. Now, in two independent samples, what happens is that the number of observations in the two groups need not necessarily be the same. Let's say, suppose the number of observations in group A, so number of observations in group A is 250. And number of observations in group B is 260. So, in two independent sample tests, or in two independent samples, the number of observations that we have for each of the groups, right? So, number of observations that we have for each of the groups are, or I mean, they may be different from each other. Right? So, two groups may have two different observations, right? On the other hand, on the other hand, when we are talking about paired samples must have same number of observations. Paired samples. So group A and group B must have same number of observations. So over here, I'll just write it out like this. So in group A, say I have 250 observations. Also, in group B, just 250. Just 250. So in both these, so in the case of paired samples, in the case of paired sample mean difference tests, the number of observations in both the groups is the same, right? Clear? Any questions up to this point? Great. Now, can you give me an example? With an example, can you tell me of a situation where I mean, can you give me an example of two independent samples and a case of two paired samples? So a respective case, a case when each of these respective situations can occur. No, I mean, salary is equal. Okay. Okay, so Piyush has given us a good question, an example. A male salary and the female salary is equal versus they are not equal. So over here, our alternative is, yeah, so alternative each one is not equal versus, so that's okay. Yeah, so over here, the number of males and the number of females may not be the same across the groups, right? So in that way, yes, it is possible. Now I'll give you two basic examples, right? So these two examples are my favorite because I have always felt that these two examples help you, I mean, helps the participants understand the things better, more from a business perspective, right? So what you said is male female salaries are equal versus unequal. That's absolutely true. But let's not use this example because it contains implicit gender implications, gender issues, right? And these days you don't know who may take it how, right? So I don't have a problem with the example, Piyush, but I would suggest, or rather, I would give two of my favorite examples as well to add on to whatever you have said, right? So over here in independent samples, let's say there are two pizza houses, right? So there is Domino's and there is Pizza Hut, who are kind of involved into a competition, right? So who wants to go faster, who can go faster. So in this case, what happens is in the so basically in a mall, right? So both of these two have their outlets side by side, right? And each of them has a certain turnaround time of providing the pizzas, right? Now it is seen that the number of customers in Domino's has been increasing, and that in Pizza Hut has been going down. Now, why is this so? So, what the business does is the business looks into multiple factors and they come across one factor is the average turnaround time. And they see that the average turnaround time of Domino's is less than the average turnaround time of Pizza Hut. Right? So, where Domino's gives the turns around within 8 minutes, for Pizza Hut, it is 8.52 minutes. Now, the question that comes out over here is that is this a significant difference. Now, why is it an independent sample? Because these two are totally two independent companies having their two independent observations, and the flow or the queue at Pizza Hut is independent of the queue at Domino's, and hence they may not have the same number of observations. Having said that, the next thing that we would like to kind of have is, so having said that, so so over here, when we are trying to do the mean difference test, right? So in this case, the number of observations are independent, right? Dominoes and Pizza Hut are independent of each other. Now, let's take a case where the government, or say say what Domino's has done is, what Pizza Hut has done is, Pizza Hut has analyzed and they had designed a strategy and they had designed incentive structure so that the turnaround time can be reduced, right? So now what they had is, they had taken 100 turnaround time, right, of 100 turnaround time observations, and to those they have applied a certain strategy, and to some they have not applied that strategy. Now what they do is, after they have applied the strategy, they want to see the respective turnaround time at each part of the day, or whatever. So now you see that the number of observations, so there is a pre-treatment, post-treatment kind of an exercise, right? And in such a case, you know that the number of observations in the first group and the second group will be the same, because it's on the same set of observations that a treatment has been applied and the outcome has been generated, right? So if there were 10 people, right, on whom they had applied the strategy, incentive design, and everything, and has improved the turnaround time, and they see that yes, the turnaround time of each of these people have gone down marginally, right? So now, is the amount that it has gone down, is it significant or not? Has the turnaround time significantly gone down or not? So in such a case, what they do is, there is a pre-treatment, post-treatment impact. And when there is a pre-treatment, post-treatment impact, right, what we have is a paired sample mean difference test. So when we are doing a paired sample mean difference test, we are doing the mean difference test on the same set of observations, but after a treatment has been applied. So there is a pre-treatment, post-treatment activity. Whereas when we are doing an independent sample t-test, we are doing the t-test on two totally separated and independent samples, right? Right. So is the concept of independent samples and paired samples clear to us? Okay. Anshul, Anshul, is it clear? Pradeep? Okay. Great. Great. Okay. So basically, so if you have a continuous variable and you want to understand whether that variable has a significant discriminatory capacity or not, what you do is you look into its average behavior across the different two categories and you check whether the difference in the average behavior is statistically significant or not. So that is precisely what the framework for continuous variables are. Now the next part that comes out over here is that if I have a categorical variable, right? So then how does that work? Let's say I'm trying to design an acquisition scorecard, right? And so I have my dependent variable as y equal to 1 if bad, equal to 0 otherwise. And I have a variable called delinquency history. So I have a variable called delinquency history. Now, delinquency history is a variable which has been extracted from the bureau, right? So, delinquency history is a variable which has been extracted from the bureau, right? And mostly is a categorical variable. How? Let's say it contains the following categories. 0 stands for no credit history. So this borrower is a non-delinquent borrower because he doesn't have any credit history, right? Okay. So the next thing that we have is, so the next is no credit history. The next part that we have is uh, never delinquent. So I'm talking about a particular borrower. I'm talking about a particular person who has, or a borrower with history who has never been delinquent, right? Never been delinquent. Second is delinquent borrower. So this borrower has been delinquent at least once in the previous credit history. So there has been a case where at least one case of a delinquent loan reported against this borrower. So delinquent. And third over here is a critical account. So critical account is that in the history the borrower has gone critical and the borrower has become a bad borrower in some of the historical loans that they have taken. Right? Now, this is the case. So I have two things. For each of the categories, I'll have a distribution of the good and the distribution of the bad. Now, if the distribution of the good and the distribution of the bad is significantly different from each other across all the categories, and the bad rate ranks, and there's a rank order in the relative distribution of the bad rates across each of the categories, then we say that this categorical variable is a good distinguisher between y equal to 1 and y equal to 0, and it will enter the model development exercise going further, right? So the next stage that we need to talk about is the categorical variables and how is it that a variable selection exercise can be done for the categorical variables, right? So this is the next stage of our discussion. So, but before we move into that, let's just take a 5 minutes break, right? Give me just 5 minutes time. I'll just be back and we'll get started. Thank you. Till then, you guys can just go through very quickly through whatever we have done. If you have any questions, you can get back to me, or else you can take a break as well. That's absolutely fine.
This conference will now be recorded.
Hello. Uh, am I audible? Can you hear me? Okay. So let's start with the questions that Rinma and Piyush had. So both the questions was around the fact that how is it that this categorical variables distinguishing capacity be identified, right? So I did not explain that. I'll be explaining it now. So I believe as I move ahead, your questions would get answered. Right. So, but before I move on, I'll just go through the questions that you guys had posted, and then we'll take it up from there. Okay, so Piyush's question was, does it mean that the less than 30 plus the 30 delinquency bucket should have more customers, but should have low number of customers in the delinquency bucket plus 90? Okay, so when I talk about rank ordering is not necessarily in terms of the number of observations. Right? Now, yes, we would generally expect that the number of accounts in the non-delinquent bucket should be much more than the number of borrowers in the delinquent buckets, delinquency buckets or in the default buckets, because some of the accounts from there are flowing into these buckets. So obviously, yes, the number of accounts will decrease as you move across the buckets. But along with that, what most important, what the most important concept of rank ordering is that the concentration of the bads, the relative concentration of the bads across the buckets should either increase or decrease in a given manner, right? So basically, I should expect that across the so if I am actually a kind of if I order all the borrowers in terms of their credit histories, right? Now let's say there is a borrower who has never been delinquent or bad in his entire credit history. So he has been taking loans for the last 5 years, and over the last 5 years he has never been delinquent. He has never been, he's never been. What should I say? He's never been defaulter or anything. Now you would expect that this kind of a borrower. So if you give loans to 100 of these borrowers, let's say you see that 8 of them turn out to be defaulters, right? Now when you give out of now you move to the next category, that is delinquency. So you had given loans to 100 borrowers who had delinquent credit history. You would expect a greater proportion of these borrowers to turn out bad in the future, right? So you see that the borrowers, say if you give 100 loans to borrowers who were never delinquent and 100 loans to borrowers who were previously historically delinquent in one or more products, you would expect a greater proportion of the borrowers from the second cycle, from this delinquency history too, to turn out to be bad because they already have a delinquency history. So they are relatively more risky than the borrowers who have never been delinquent, and hence, if I give a loan to these borrowers, they would have higher chances of going bad. Now, given that the loan has been given to these borrowers in its distribution, the bad rate, the persons who have turned out bad from each of these categories should rank order. So I would always expect a larger proportion of the borrowers, the largest proportion of the bad borrowers from category 3, the second largest proportion of bad borrowers from 2, that followed by 0, and then never delinquent. Because if borrowers do not have any credit history, they are new to bank borrowers, right? First of all, they are treated separately because they are generally a small segment. Majority of the segment, so the risk-based segment is based on the delinquency, on the historical delinquency patterns. So a borrower who has defaulted in the past has very high chances of defaulting if I give him this present loan, right? So that is what I meant by rank ordering. That the so I would expect the highest proportion of the bad borrowers to come from delinquency credit history 3, the next from 2, the next from 1. So it's like that, right? So that is the question. That's the answer to Piyush's question, right? So by rank ordering, I do not mean the number of borrowers in each categories, but rather I am talking about rank ordering in terms of the relative concentration of the bads. Clear, Piyush? Any questions around that part? Great. Okay. Now coming to Mrinmoy's question, that how do I do the distinction? Right? Let's say my dependent variable has two categories, right? And the the variable itself has four categories, right? So what I'll do is I'll put the variable categories on the x-axis. So over here I'll write it like this. This is 0, 1, 2, and 3, right? And over here what I have is fx, which is the cumulative distribution function. Now over here what I'll do is I'll take up each of the categories, right? So I'll take up each of the categories and I'll plot it over there. Let's say that, so first what I'll be plotting is I'll be plotting the, say, the distribution of the goods across the categories. So, so 0, category 0 has some number of goods. 1 has some number of goods, 2 has some number of goods, and 3 has some number of goods. Right. Say the total number of goods in the data is 700. So the highest number of goods will be with this, let's say 550. Out of this, 100 is there with this. That's 650, right? This is 40. So now once I have done this, right, so you can see that this is the frequency. So now what you can do is you can compute a relative frequency, and from there you can compute a what should I say? You can compute a so basically what you can do is you can compute a this thing, a cumulative frequency from there, right? So the highest value over here is 0.55. So the highest value is 0.55. Then comes 0.65. Then comes 0.69. And then finally it goes up to the last. Right? So this is your 1. Similarly, the number of bads. So the lower number of bads that we have over here. So the bads will be initially low. So your bad distribution starts something like this. Need a separate color. Yeah. So this is the cumulative distribution function, frequency for good. Now, over here what you get is you get things starting a little on the lower side, right? So things starting little on the lower side tend to match it up, and it increases up to this. So this is your cumulative distribution of bad, f of b, right? Now the maximum difference that exists between these two distributions is the figure which represents the difference between the distribution of good and bad across the categories. Now this is your supremum of the absolute differences. If good minus the cumulative distribution function of bad. Now with these two parts together, what we get is, so this gap shows the maximum gap. Now if this gap is a significant value, then we say that yes, this categorical variable can distinguish clearly between the good and the bad. And this test is the famous Kornogov-Smirnov test statistic, or as we call it, case test. Right? Just check. Have you guys understood this concept? This is a very important concept over here. Any questions, any queries? Yes. So, so is this way of the variable selection clear to us? I'll move. Okay. Okay, great. So now what do you think? Right. So we have seen this mean difference test measures and segregating the values of testing for continuous variables, for categorical variables. We have seen this. Now the question that comes out is, what is a possible challenge that you can see with this particular way of variable selection? What is a possible challenge with this? So take 2 minutes, think about it, and give me an answer. That this is the possible challenge I foresee when I use this measure or when I use this approach for variable selection. You can unmute yourself and also say that, or you can type in your answers into your chat box.
Yeah, Tanmay, so with this method, we would not be able to distinguish between monotonicity and multicollinearity. That is, if two variables are contributing same to the independent variable, then we'll select both of those variables. And this will include the noise in the model.
Yeah. So up to this stage, that like whatever you said looks plausible. But after this, you enter into the model development stage, right? When you do your VIF checks and all, and so multicollinearity would get sorted out in the next stages of model development, right? But that is not where the problem actually lies, because you have your VIF tests and you have all your other tests which will help you sort out multicollinearity, remove variables, or get variables converted into a covariate and get that problem solved. So that will be taken care of in the later stages. Now, my question, I'll just rephrase my question, that what do you think would be the greatest challenge for developing a model if the variable selection is done in this way?
Uh, so Tanmay, there is a guess which I can make. So with this method, we would be able to select the variable wherein the predictive power of each variable is getting increased cumulatively.
Okay. But that's not where it is. The answer is more basic. Just look
Okay.
into these two examples, right? And then just try to figure out these variables are entering into the models. Then the model development is happening. So where do you think a problem can arise?
Uh,
Okay, I'll give you the answer. So, any other guesses? Any other guesses? Okay, just take 2 more minutes and try to put in your thoughts, then I'll tell you the answer. Otherwise, you'll not get a hold of the thing. So, any other thoughts apart from what Anshu said? So what Anshu says is that there are these things. So when you're using variables, the variables predictive capacity would be increasing cumulatively. But that's a good thing in a way, Anshu, because the explanatory capacity of a model would be higher. But that's not really the reason, right? There is something more basic to it. Anyone else would want to try? Harish, Pradeep, you. I'll tell you. See, over here, I have a variable which is continuous in nature, right? And over here, I have a variable which is categorical in nature, correct? Now, try to imagine the data that would be formed. So I select, let's say I select delinquency history into the model. I select EBITDA for the modeling exercises, right? So the question that comes out over here is that how would the data set look once I have done the selection? Now, let's see. So over here, I'll just draw the line. So I have the account ID 001. Then I have EBITDA. The EBITDA is in millions is 3.5. Now the delinquency history is 1. The response of the dependent variable flag or the Y flag is 0. Right. Now you will be developing a model on this. Over here, one variable is a continuous variable. The other is a numeric categorical variable. Now, when you run the regression will take this not as a category 1, but as a number 1, and it will run the regression, right? So then the regression that you finally run, a logistic regression, whatever, this one does not make a sense, and the regression that you get would be a nonsense regression because there are two different heterogeneous types of variables involved into the model. Hence, whenever a model or scorecard which involves a mix of both categorical and continuous variables are involved, you need to do a common transformation for both. We need a common platform or a common transformed value of the variable. Common transformation. And that is where, you know, That is where the weight of evidence comes into play. So the weight of evidence as so weight of evidence is a transformation measure which helps us get both continuous and categorical variables into one common ground, right? So weight of evidence does a transformation or a common transformation of categorical variables into quantitative values, right? So what we do is so as a very general practice, what is done is all the continuous variables in the data are first converted into categorical variables. Once you have your categorical variables, you bring in your weight of evidences and your information value. Right? So this is where the role of weight of evidence comes into play. So, and since weight of evidence does a common transformation, so from the weight of evidence, we compute the information value, and at one go, using the information value, what we generally do is we identify the variables. So we identify the informative capacity of the variables, right? And based on the information value, we do our selection, right? But again, the variables which are selected using the information value approach and the variables which will be selected by these two approaches should at the end reconcile. Only then you know that the selection procedure that has happened is a proper selection procedure. Right? Clear on this part?
Uh,
Yeah.
so Tanmay, a very basic question
Mhm.
on this. For weight of evidence, we
Mhm.
always need to convert the continuous variable into categorical variable. Is it how is it?
Yeah, because weight of evidence is a variable, it's a transformation which is based on categorical variables, right?
Okay.
It looks into the bad, good percentage good and the percentage bad distribution across the multiple categories of a categorical variable, and based on that, the transformation is done, right? So once I explain how the transformation is done, then it would also become evident as to why the transformation to the categorical variable needs to be done first, and then weight of evidence transformation needs to be done, right? So I'll come to that part. But is the logic of the transformation clear to us,
Yes. Oh,
everyone? Yeah.
I have one question.
Please.
Yeah, like, do we also use WOE variables in decision trees as well?
Yes, yes, yes. But generally, you know what? When we are using decision trees, right? So we just use the data as is,
Okay.
right? But yes, you can do like once you have done your WA transformation, after that you can also use your decision trees. That's not a problem.
Huh? It is not a mandate,
But
right?
no, but because you see, if you are developing a decision tree driven model itself, then you don't need to kind of do it, because you can use itself, you can use your categorical variables then to create separate segments. And then
Right.
using the for each segment, then you can divide it into further sub segments using the decision tree on your continuous variables. Now, weight of evidence transformation becomes more of a mandate when you are developing a scorecard, right? Because in a scorecard, you need to have multiple categories and the scores are given corresponding to these categories. So, categorizing the variable, the explanatory variables, is a very important.
Uh, Tanmay, I have one question. This is Harish here.
Yeah, Harish, tell me.
Yeah, when we do weight of evidence transformation, there will be
Mhm.
some loss of information, right?
Right, right.
Uh, so how do you take a call? I mean, sometimes weight of evidence might not be required. You might get a good model even without that.
Yeah, you can get a model without weight of evidence. So basically, what happens is, I'll tell you. So while working at the commercial portfolios itself, so I did not have much of a categorical variables, right? So most of the variables that we had was continuous variables, and we needed to estimate the probability that a borrower would default, right? So and then based the probability of default, we had the client had their own ordinal rating scales to which the borrower was mapped, and the score was corresponding to required to do scoring as such, right? So what we did was we used those variables. We did a simple mean difference analysis, and we identified the variables, the optimal variables, and based on the optimal variables, we had just developed our models, right? So that's possible. However, when you are doing your weight of evidence, you do tend to lose out on information to some extent. But what matters most in weight of evidence analysis is that the ordering should be the same. So basically, when you're moving from a category 0 to a category 3, the weight of evidence should monotonically either increase or decrease, right? Otherwise, your weight of evidence is not reliable as such. So as long as your weight of evidence measures are rank ordered, right? They are ordered across the categories, or they are monotonically increasing or decreasing across the categories, and that increase or decrease is in line with the business requirements, you know that that variable is okay, right? So in that case, like the extent of distinction is not important. What is important is that whether it can distinguish or not, because once you identify these set of variables and you enter these variables into your logistic regression model, the next set of selection or the most accurate variables will be selected by selection equal to stepwise regression when we do it in logistic regression in SAS, right? So at the variable selection stage, all we want to know is that which are the key variables that should enter into logistic regression, just to reduce the load of the analysis. Now, after doing weight of evidence, you see that the weight of evidence do not rank order, so so the monotonicity is not maintained. You know that there is a trouble, right?
Right. No, my question is, I mean, how do you take a call whether you want to go for a weight of evidence model or a normal model? Because weight of evidence requires some additional work and it might take some time
Hmm.
to.
See, basically, if it's a scorecard, then you have to do a weight of evidence analysis. You cannot help it because
Okay,
each variable will have certain categories, and each categories will have a weight of evidence, and based on the weight of evidence, you will have a score for each of the categories. So that needs to be taken. So, but whenever if you are developing a simple PD model, then you can do without weight of evidence as well. That should not be a problem.
got it. It's only for scorecards. I
For
mean,
scorecard,
it's
it's mandatory. It's mandatory.
got it.
Okay. So talking about the weight of evidence. Okay. Good. So now, so over here, the next part that we talk about is the concept of the weight of evidence. So what exactly is weight of evidence? Why do we need weight of evidence? So that is something that we need to talk about, right? So let's do something. Let's stop here for the day, right? And let's take up weight of evidence this concept afresh. And once variable selection is finished, we'll talk about the validation. And from there, we'll dive into implementing these scorecard models on the SaaS platform, right? So I believe we'll go down on the SaaS work next week onwards, right? So next Saturday, I'll complete the overview of scorecard development, the one that we are doing now, and then we will start off with the SaaS part, right? So thank you guys. Thank you for your time, and let's catch up next week. In the meanwhile, what I'll do is I'll share over all the pending documents and recordings with you so that you can go prepared. You'll be prepared before the next session of the workshop. Thank you. And I'll share over the link for the 11:30 workshop on IFRS 9 by 11:15.
Thank you, then.
Thank you. Thanks a lot.